Okay, thank you very much. So maybe a couple of words on what I'm doing right now. So as you said, I'm created a venture capital fund. So it's a company that aims at financing high potential startups in the tech area. And my objective is to help European companies, European businesses, European startups to grow their business, but also to try to address the Asian market. So I try to help them come to Asia and find new business perspectives, new markets, maybe new investors, maybe new technologies. And what I would like to do from now on is to raise a second fund. And with this second fund, I would like to start investing as well in Asia, so in Asian startups, and help these Asian startups, maybe Korean startups, to develop their business in Europe. So the same thing that I'm doing for European businesses, I would like to do for Asian businesses. So that's basically what I'm doing. So it's very interesting because we talked with Janse about crowdfunding, and as you well know, there are many different ways to fund a business. When you're a startup, of course, it's not very easy, and you must find the right moment, the right amount, and identify the right type of funding that is suitable for your business. So crowdfunding is one. You can also bootstrap. Bootstrap means fund your own business with your own money or with the money of friends and family, etc. You can have access to bank loans. You can have contests organized by the government sometimes. And VC, venture capital, is one of the sources of funding that you can find. And it's usually a company that will invest in your company, give you money in exchange for equity. And usually the venture capitalist is looking for a return, so is looking to sell its shares in your company in a 3 to 6, 7 years horizon, which makes it a mid-term, short-term investor, not a very long-term investor. So instead of describing very theoretically what a venture capital is, I thought that it was maybe more interesting for the audience, and especially for founders, to have a look at how we analyze deals, so how we look at startups who come to pitch their projects, and how we decide if we're going to finance them or if we are going to drop them. So I will show you some slides about what we call an investment memo, and it's on the basis of this kind of document that after a due diligence process we decide or not to invest. So I'm not sure that you can see. Yeah, okay. Oh, I think it's going too fast. Okay. So first, this is really a document that we use to make our decisions. So first of all, we will start to look at the business of the company, and we'll write a business summary and description of the deal that is presented to us. So I took the example of a gaming company, a mobile gaming company. And so what is on this slide? It will be a business outlook, so the description of the business of the company. Also, we'll add some major KPIs, so major figures about the revenues, the profit or the losses of the companies, the cash burn, the growth perspectives, this kind of things, so economic figures. We will also say how much money the company has raised so far, with which investors, were they business angels, were they friends and family, were they already venture capitalists, etc. We'll look at how the deal was sourced and the deal terms, so how much are we going to invest if we invest, what share of capital we will obtain in exchange for this money. Also, we will look, and it's very important for us, at what will be the use of the proceeds. So what will the company do with the money we put in the company? Will they hire new people? Will they reinforce R&D expenses? Will they launch a new product? Will they open new countries? These kind of things. And also, we will try to look at the exit perspectives. So will this company probably have an IPO, so become public, be listed on a market, or is it a good candidate for an acquisition by a bigger player? This kind of things. So then we try to look at the consistency between the deal and our investment thesis, because each VC has an investment theory or investment thesis. So, for example, I invest only in late-stage companies, which means I will not invest in very early-stage companies. So if a company is too early, doesn't make any revenue, for example, it's not consistent with my investment thesis. So it's very important to check that the deal and the company fit the investment thesis. First, we look at the team. Of course, it's very important to assess the team, education, background, and ability to execute the project. And then we will look at the key risks. So how sound the business approach of the team? Are they agile? Will they be able to pivot if the business is not fit for the market, for example? How do we address the risks that are posed by the team? So this is the part on the risk that I was mentioning. Key risks and concerns. So in this deal, which are the risks presented by the company, by the market, by the competition, etc. I'm trying to be as fast as I can because I see that time is going. So we try to map all these risks and see how we can mitigate them. Then we will analyze the company's specific positioning and the business model of this company, and we will also try to benchmark the stories of other companies that have failed or succeeded in the same sector to try to benchmark a bit. Then a very important part is the team assessment. So it's very important for us to have a very good assessment of the quality of the team. And usually you will hear that for VCs, VC is not a science, so you rely a lot on the human part and on the quality of the team. So this is a very important part of the due diligence. So we will look at the team and analyze their academic background, but also their experience. What have they done before? What is their track record? What is their reputation? How do they work in a team? This kind of thing. So it's a real deep dive into the team, and we'll do that with all the key people of the team. Then we'll have a sort of synthesis on the team assessment, and we will give good points or positive assessment on all the key person of the teams, and in red we will put some risks that we've identified and try to see how we can mitigate again these risks. So that's still team assessment. Okay. Then we look at the product. So, for example, this was a game. We look at the product, we describe the product, and we see if there is a tech edge. Well, it's not really the case in a game, in a mobile game, but we try to identify if there are barriers to entry, if the product has something different, if it's market fit, etc. So we'll try to really assess the quality of the product, and also its perspectives for further development. We look at also sometimes at the product roadmap. So that's the next game that was going to be developed, for example. Then we look at market and competition. So this is also a very important part. We try to assess how the company positions itself on a mapping with strengths and weaknesses compared to the competitors. Then we try to analyze the direct competition. We make comparisons between KPIs and etc. and characteristics of the companies. Then sometimes in this case we analyzed a game that was in direct competition with the company's game. And then comes a very important part, is the business analysis. So for that, it comes to the really financial analysis of the deal. And for that, we rely a lot on the business plan of the budget that are presented to us by the company. And then the important thing is really to challenge what the company says. So usually they present a business plan over the next 5 years, say, for example, that is based on certain assumptions in terms of growth of sales, growth of revenues, etc. And sometimes we need to challenge these assumptions and to try to benchmark between a low case scenario, a base case scenario, and a best case scenario to see in which revenue or profit path the company is positioned. So this part is really very important, and it requires some financial analysis and modelization as well, because we really need to challenge what the company is telling us about its economic perspectives. Then we also will look at the exit potential. So as I said before, venture capitalists are investing in companies. They invest, for example, 10, and they expect to, when they sell their shares, they expect to have a return on investment. So they expect to gain more than 10, basically. And all their job is to maximize the value of the company so that when they exit, so when they sell their shares, they will make a maximum of profit. So that's why at the moment of the deal, we need to try to anticipate what kind of exit we can expect. And for that, we will benchmark other companies that have been acquired or that have gone public by getting listed, for example. And so we will make comparisons. We will try to assess the valuation of the company at exit, for example. This is also a very financial part and requires some modelization. And it's, of course, very difficult because, as I said before, it's not a science, it's not a pure science. And so we need to have good intuitions and experience to anticipate that. So that's also about exit. Then we will analyze what we call the equity story. So we will look at the capitalization table. So who owns which part of the company, who owns which shares of the companies before we invest and then after we invest. So that will be the current cap table and cap table after investment. So who are the investors who own the company, basically? Are their interests aligned? Are there some people, some investors who have a too big a share and who might be a problem when, for example, we want to exit, this kind of issue? So what we call the cap table, the capitalization table, who is sitting around the table in the capital of the company is something very important to assess also the quality of a deal. Okay, that's also, we analyze sometimes when there are very big investors who have large shares of the company, we will look at them and try to assess their interest in the company. Are they going to be to want to sell very quickly, or on the contrary, will they want to keep their shares very long, etc. So we try to identify the interests of these big investors. So we try to benchmark also the equity story of competitors, and that's also some financial analysis. And then we try also to give an assessment on the deal terms. So as I was mentioning before, is it a primary investment? So are we buying new shares? Are we buying shares from another investors? Are we how much of the company do we own? Is the valuation of the company satisfactory? This kind of things. Will we have special privileges attached to our shares? So this is really the deal terms analysis. And then finally, we do reference calls. So that's a very important part as well. We call people, former investors, former team members, former employers, to make sure that our assessment of the deal is accurate and that we do not take a risk to have people who will not be strong enough to resist the pressure or who will not work well together. So we really make sure that our assessment, our team assessment is accurate. So I think I went quite fast, but of course this kind of memo requires a lot of work. Usually it's weeks of work because it's, of course, we want to make sure that we make a decision, an enlightened decision. So we need to really put a lot of effort on and discipline on this work. So that was how basically, and I think it fit in 15 minutes, so I'm very proud of myself. This is basically in rapid motion how we make a decision to invest or not invest in a company. So that's what I wanted to share with you today.